My next guest says market breadth is the worst it's ever been for the S&P 500, and this has to change if the AI revolution is for real. Joining me now is Paul Hickey, co-founder of Bespoke Investment Group. Paul, thank you for being here. Great research on this. I was surprised by the superlative that Tuesday was the worst for S&P breadth in ever, at least in terms of an up day. What signal does that send about kind of where we are right now with regard to concentration as well as just the outsized moves that are impacting the broader indexes?
Yeah, so Leslie, I think what you've seen, so Tuesday was just an example of how the concentration in the market has become pretty extreme late over the last couple of years and to where we are now. On a day like Tuesday, where we had 398 stocks in the S&P 500 trade down on the day, historically, you tend to see about a 1% decline in the S&P 500 on those days. On Tuesday, we were up 23 basis points. Tuesday was also part of a 4-day string where we've seen the market cap weighted index outperform the equal weight index by over half a percentage point 4 days in a row. That's never happened before. And we're now on 2 months in a row of the cap weighted index outperforming the equal weighted index by at least 2.5 percentage points. So that you have to go back to 1999 for that. So there's a big bifurcation in the market between the haves right now and the mega caps and the have-nots, the rest of the market. But as you said in the intro, if AI is going to be as big as we all expect it to be, the benefits are going to have to start accruing to these other firms down the line. And I think we will start to see that. And I think part of the divide this month that we're seeing is in part due to the government shutdown. So that's created a lot of uncertainty on the part of smaller companies, and investors are flocking to the mega caps as defensives nowadays. And so you've seen this, you really saw the gap widen in the last 6 weeks between the cap weighted and the equal weighted indices. So I think once we get signs that the government will reopen, you'll start to see that divide reverse.
So maybe that flight to the big cap tech is similar to what we saw with gold, although that's reversed a little bit. Do you expect to see a revision to the mean with regard to equal weighted S&P 500 and market cap weighted?
Yeah, so it's interesting. We put this all on the mega caps, like the $7 trillion club. But what you've seen is across all sectors so far this month, except the materials sector, you've seen the cap-weighted versions of the sectors outperform the equal-weighted versions of the sectors. So you're seeing take consumer discretionary, for example. The sector's up 1% this month, but that's basically all Tesla and Amazon. Outside of those two stocks, they're down an average of 3% this month, and 75% of the stocks in the sector are down. And the consumer, I think, is feeling some, pain here as a part, government workers are becoming more concerned, and overall consumers are just becoming a little bit more concerned given the uncertainty. But again, as that starts to revert, when we do get the government to reopen, which it will happen at some point, and I think once you start to see travel get delayed, the Senate will come back and they'll reach a deal. So I think at that point, you want to start focusing towards the consumer stocks and those that are leveraged to the consumer, because all this reduction in spending, you'll see a boomerang effect come at that point.